So the markets are going crazy. The bond market is all over the place. Lots of fears of a recession going on right now. And today I'm bringing you my friend, Greg Kojak, wealth advisor, to give you some advice. And let me just start off by saying I get a lot of emails from people with data about the market and other stuff. A lot of them go right to the spam folder. Greg's do not. I read every single word of his messages because of the details he provides. So, Greg, I'm going to turn it over to you. I know you got to do a quick intro for legal purposes.
Yeah, good to be with you, Brad. So my name is Greg Kojak. My firm is Kojak Capital. Just a little bit of disclosures, which is mandatory by regulation for my industry. My physical address location is 130 West Liberty Drive, Suite 200, Wheaton, Illinois, 60187. My website, kojakcapital.com. Direct line to me is 773-572-6455. And securities and advisory services offered through Commonwealth Financial Network, member FINRA, SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency or Kojak Capital. So that's it, Brad.
Great. Now that we got through all the technical stuff, let's dive in right away. I mean, top question on everybody's mind: recession. Are we in one? Are we going to have one? Are we not? I know you're all over this data and you have some information to share, so I'm going to just flip it right back to you.
Sure, absolutely. So the one thing that we want to focus on, or at least get started on when talking about a recession, is GDP. So GDP is the indicator of growth in the U.S. economy. And so by definition, a recession would be two consecutive contraction periods of GDP. So you know me, I like charts, I like to share things, so I will actually share a few charts throughout our time together. So what I have here is the GDP going back to 2001 and kind of the blue dotted trend line of roughly about 2%. That's kind of been the historical average. And so we do see a little bit of a dip recently, but I also want to focus here on this side because the components of GDP we should really talk about, not at length, but just know what they are, because that's essentially what we're looking at if we're going to have a recession. So the components you can see on the right-hand side, we've got housing, we've got investment ex housing, government spending. The biggest portion is consumer consumption at 68%. And then we've got our exports, which currently are negative because of the strong U.S. dollar.
And real quickly, I hate to interrupt, but housing, 4.3%. I mean, the Great Recession was largely caused by a crash in housing. At only 4.3%, you would think it's a much bigger piece of the market share.
I think it's pretty close to the historical average. We do have to go back in time and talk about 2008. A lot of that was caused by bad loans. And so when the housing, that whole bubble occurred in 2008 because mostly the financial markets became unstable with all the bad lending that actually came due. So it wasn't completely housing based, but it was a component of that whole 2008 debacle.
So, and just so people understand then, so we're talking about housing as it impacts the GDP on a monthly annualized basis versus, the balance sheet of housing and that massive loans that are out there, right? Kind of look at this as more like the income statement and that more like the balance sheet in essence of the U.S. economy.
Right. Yeah, exactly right. So, in looking at this as a whole, you can kind of see that, consumer consumption is the biggest component, right? But let's say we do have a little bit of contraction in housing. Let's say we do have a little bit of contraction in government spending or even consumption. All in all, there's no one big factor that would, cause a downfall. And so what the other thing we wanted to look through is the components. Break it down, components to the recession. So here's the variables used by the National Bureau of Economic Research. They identify six main factors that cause a recession. A heat map kind of tells a story. And for me, when I look at this heat map, I kind of go left to right. So we can go back up all the way to the 2020, the meltdown after COVID. Obviously, a recession, if not a depression, short-lived. But then we kind of drift past that into the years 2021 and 2022. And when I look at this, I don't see a clear pattern. And you do have instances of a recession popping up in maybe one or two of the variables, but I never see a clear six variables showing recession. And so even when you go to current day, we do see these six factors going in and out of either growth or, in the yellow would be just, stagnant. But there's no complete red zone across the board going into this year, and even in November. We don't have the December data yet, but this is kind of where we're at currently. So like I said before, if we are looking at a recession, we don't see a lot of those variables flashing completely red at this moment. And then this little chart below is kind of interesting because it takes those six variables and then it backs them up 6 months. So now we can take a look at what's been happening directly over the past 6 months. And so when you see a positive, that means that the variable has held, over the past 6 months. So we do see that 5 of the 6 are either flat or positive, and it's just wholesale and retail that actually has been the only negative variable over the past 6 months.
So this is an excellent chart. It is very interesting. I mean, obviously red is bad, right? And then you've got a lot of green in 2020, which doesn't seem like you would expect that, but that's probably the recovery from that steep decline that happened in 2020. But then the rest of the year, I mean, obviously, the more that it shades lighter in color versus the green. So if you look at the last 4 months on the chart, August, September, October, November, there is a lot of lighter shades, which means that things aren't super rosy, right? But what you're saying is it doesn't mean we're in recession either. The only thing that seems to be down right now is kind of the retail wholesale sales at the moment, at least over the last 6 months consistently.
Right, and that's what we're seeing. So even if you go back and look at periods in 2021, you'll see that there were times where there were solid red colorations, and so 3 of the 6 variables, right, we're showing recession right here. This would be February of 2020, or I'm sorry, February
21, I think.
Yeah. So like I said, but you can't focus on just one variable, as some people do, right? You read a headline and it'll say payroll employment is down, right? Or whatever factor that you want to focus on. You really have to take a look at all of them together and then kind of see where we're at in relation to where we've been previously.
Yeah, so I just saw a headline yesterday indicating that obviously GDP in the fourth quarter was positive, but that there was a trend line in that GDP, and I think it was looking at some of these variables where there was a substantial decline in a couple categories, which were cause of concern. Now, I know those are fresh numbers. I think, like I said, came out yesterday. Have you had a chance to dive into those at all? Do you see much of a change from what you're seeing here in December of 22?
The actual GDP growth number came out yesterday. You're right. It came in at 2.9%, and that was above what the estimates were. However, it's down from the third quarter. And so we are seeing kind of the overall effects of interest rate increases, right? The whole idea is to ease on liquidity and ease on lending, and to let the economy kind of cool itself off. So if we look at where those are trending, I've got this chart as well that shows GDP over the course of the year, this year, 2022, going into 2023. So here's kind of the growth of the GDP growth over those first three quarters. This just came in yesterday. This is where it was projected to be, somewhere in the 1% to 1.5%, I think, and we ended up at 2.9. So it's actually going to be right about here. So then the forecast that, and this is actually done by Goldman Sachs, where they projected out into 2023, the first, second, third, and fourth quarter, and you can kind of see these factors that go into the overall GDP, and it's staying pretty consistent, but it is noticeably lower than what we saw especially in the third quarter and the fourth quarter of 2022. But again, if you kind of look at some of the different variables and factors in there, whether it's fixed investment or housing, like we were talking about, the gray coloration there, government spending, they kind of are trending in a similar fashion. So consumption, again, looking at that dark blue color, is saying they're projecting to stay pretty consistent through 2023. And as we were talking about, that's one of the biggest components of GDP. So I do see this kind of overall lower GDP than we've seen previously, but they're kind of forecasting consistently lower.
Okay, well, and it's interesting because I keep hearing like 75-80% of bankers, or I shouldn't say bankers, economists for major banks are predicting some sort of recession or setback in the next 12 months. Is Goldman Sachs then one of the outliers? Or, if you put up 10 different bank charts, how different would they all be today?
That's a good question. I do end up seeing a lot of variables. Like I said, I think some economists focus on one specific variable that they think is more important than anything else, like unemployment. And you'll start hearing about economists saying, well, people are losing their jobs. I mean, we see the headlines that some companies are cutting back on jobs, and to a certain economist, that's really important, right? Because if somebody loses their job, the consumption goes down. And so other economists might think differently, where they might say, housing is really the important one, the overall sector of building homes, but also owning homes or buying homes. They might focus on that. So, it's hard to tell, but like I said, I've seen both sides, of that barbell go, trending heavy recession all the way to it should be short-lived and, a soft landing.
Okay. And then to take it to the next level then, because you mentioned it, interest rates are huge for me right now in commercial lending. I mean, all my clients are screaming about how much they've gone up, especially those businesses borrowing at variable rates. I have kind of been under the belief that, the Fed tends to somewhat overcorrect at times. I mean, it really they didn't really give it enough time for those large increases to take effect. Obviously, we started seeing it, in my opinion, in the end of the third quarter and fourth quarter. Where do you think the Federal Reserve is going to go? Do you think that there's still some more rate hikes to come, or do you see, because GDP looks to be trending down, that they may be starting to think that they're getting it under control? And I know it's a guessing game for you, just like it is for me, but I just kind of want to get the sense from the numbers you're looking at every day.
Yeah, so my thought is, and I think I've got, of course, another chart for that.
I figured you did.
So here are, it's interesting because we could classify it in two ways: what the market and the world believes interest rates will be, and then what the Fed has actually said and what they're projecting. Right. So this chart will show you exactly that. So the historical interest rate, you can see going back to 2000, it goes up, it goes down. Incrementally at times and very aggressively, as we've seen in the year 2022. So the Fed has said they're getting close to the end, but they still think that there's some additional need for interest rate hikes. And so that's where you see the dark blue diamonds, and that's showing what the Federal Open Market Committee, the Fed, is saying rates should be. So they are saying somewhere in the area of like over five to five and a quarter. And you can see the green is market expectations, which are just a little bit less. So expectations are not that far from what the Fed is actually saying themselves. But I think the market is moving in a direction and thinking that the rates won't quite get that high. So you've got a little bit of that delta between what the Fed is saying and what the market is thinking. And that's normal. It happens almost on a daily basis with any kind of projection that you can think of. But overall, the Fed has announced that their long-term terminal rate, where they think that interest rates should be set for if it was a perfect world, right? Interest rates would be set somewhere in the 2.25% to 2.5%. Which is kind of this long-term dot out here where they think eventually that's where it's going to get.
Yeah, and to put that in mind or perspective, I should say, for a lot of our customers and business owners, 2.5 on the Fed funds rate, prime rate's typically 2 points above that, so you'd be at a 4.5% prime rate. Probably about 1.5 off the low for the prime rate, around 3% or 3.25, but still a very aggressive interest rate for, funding growth, and not too dissimilar from where we've been over the last, 10, 11 years post the Great Recession.
Right. I agree with that.
Gotcha. Well, I know that you deal with not only wealthy individuals, but you also deal with a lot of business owners who have wealth, retirement accounts, and other things. Can you give any sense what you're hearing from your business owners coming out of 2022? And I'll parlay into that a little bit. Certainly I'm reviewing financials from customers all day, every day. And I will tell you that the third and fourth quarter numbers I'm seeing from companies are trailing flat to down a little bit, not substantially, but I'm not seeing we came out of 2020 into 2021 like this, maybe more like this. It was almost like a rocket. And then it slowly went a little bit like this going in 22. And now I feel like it's kind of flattening out. Customers are struggling to find those, or businesses are struggling to find those additional customers to maintain growth. What are you hearing from some of your business owners?
Yeah, so I've got, I run the gamut, and it's kind of interesting because I probably kind of like you find that there's some similarities, but there's also a lot of dissimilarities and differences just in different industries. So, for instance, we've got clients in the real estate market. They're developers. Business is down, right? Because it's a challenge to get money and make it profitable at these interest rates. I've got clients that are in marketing, and they're trending nicely. As downturns happen, you'll find that companies start to spend money in order to ramp up the marketing efforts to create more income for themselves. And so what's interesting, I'll pull up a chart that I've had for the national, looking at the United States kind of broadly. So this is really interesting because it also shows what's on the mind of the average Joe consumer, which is on the left-hand side. That's the Consumer Sentiment Index. And then on the right is the Business Confidence Index. So if you look at this, they're very they're opposites almost. If you just take a snapshot in time and look at where it is today. So when consumer confidence is actually upwards of I think the latest reading was 59 roughly, but it got all the way down to 50 just recently, just maybe a quarter or two ago. That reading,
I missed that. I didn't realize that.
Yeah, so that reading was historically low. As you can see, that was worse than the 2008 situation that we went through. It's worse than 1980. And of course, trend line stops here. But so that's telling us one thing. People are really down on what they believe is going to happen in the economy.
I don't mean to interrupt, but I mean, how can you blame them? I mean, inflation's hitting everybody's pocket. I mean, you go to a grocery store, I go to a grocery store. I constantly hear the joke about eggs, but I swear every time I get on the phone with my mother-in-law, I hear about how expensive eggs are. Same with my mother, for that matter. So, I mean, people are feeling that pain. I can understand that sentiment dropping.
Absolutely. The personal savings rate is down because people's disposable income that they usually use for fun stuff, is getting eaten up by inflation. But the one thing I wanted to kind of focus on with these two charts is consumers are really down because we've got the headlines of recession, we've got the stock markets are down, we've got a war in Ukraine, we've got inflation. So I think the negative headlines are really pulling the consumer confidence down. The average consumer is seeing these economic headlines and saying, this doesn't feel good. I'm not confident. I don't want to start spending on vacations and whatnot because I might need this money. Maybe I get laid off. So there's a lot of negativity within the consumer space. If you move to the right and take a look at the business, so this is kind of on the other side where the survey goes out to businesses and interviews them and asks them questions about their confidence. We could see that business confidence is down, but if you look at where, the 100 mark is kind of that normalized zone, right? The kind of middle of the road. And it got to 101, 102 recently, and it's been coming down, but we're at 90 roughly now, which is a little bit down. It's like 10% down from a normal, business confidence number. But nowhere near close to what the consumer is thinking, right? So there's a big discrepancy between businesses and what they think is going to happen. And again, the trend line is going down for business, but not nearly as sharply as for the consumer. So in what I think personally is, again, I think a lot of people are focused on the negativity, the negative headlines, making them worried, having concern. Whereas businesses are looking at it differently and they're saying, yes, it is slowing down, but this is not crashing. It's not coming to a complete standstill.
Yeah, I will tell you, and this is really more personal perspective than I think the data that you're providing here, but I'm not seeing signs of it just running off the hill anywhere. I do think that, like I said, some businesses are seeing some flattening out in revenues, but that's natural, right? You can't grow at a 10, 15, 20% rate year after year after year and maintain it unless you happen to be in one of those rare high growth industries. So I definitely think that it's not time to panic on the recession front. I mean, even if Goldman Sachs is wrong and it dips below a couple quarters, I don't think it's going to dip like it did in 07, 08. I think it's going to kind of do what it did last year and hover just a little bit below and maybe bounce back up quick. My personal opinion. But this is great data to understand both where consumers as well as business owners are at. I think I've just got one other real question for you today, and that's, as you're talking with clients, what are you recommending they do to protect themselves from some of the volatility going on in the market? I mean, obviously the bond market's been crazy. Certainly not saying, hey, give us specific stocks, give us all your secrets, but just are you suggesting clients reposition? What are kind of your recommendations today? And are there things business owners should be thinking about that they could be doing to maybe protect themselves from interest rates or recession?
Yep. So great question. The one thing that we're revisiting frequently with clients, not just business owners, is the concept of an emergency fund. The emergency fund is one of the biggest fundamental things that should be in place and has to get revisited because sometimes you have to dip into it. And if you use it, then we have to go back and look at what expenses look like for a particular business or an individual and make sure that if tough times come, if there are 2 quarters or so of a tough economy, the business is struggling, that you are able to tap that emergency fund and use it for paying bills, right? Necessary expenses. So the emergency fund really is becoming crucial at this point because again, we're seeing people losing their job. Unemployment is ticking back up, and you don't want to go in and start cashing in retirement accounts and paying penalties and taxes unnecessarily. So plan accordingly. We do, and like I said, we're reviewing those clients specifically, and most clients, just to make sure that they are in a good space. As this economy kind of dips down a little bit, that they're prepared.
Excellent. Perfect. And that probably goes for business owners as well. Be sure you're putting money in reserve. You're not yanking every dollar out of the business. I'm starting to have discussions with customers. Watch your expenses, right? You may, when you're growing, you tend to let your expenses get a little bit out of whack at times. So be sure you have a handle on them, that if you got some stuff you're paying for, some software or other things you're paying for you don't need anymore, now may be the time to cut it. Don't keep incurring those expenses. But no, this has been great. Any last second thoughts or advice you'd like to share, or any other graphs we didn't touch on you want to show us?
I've always got tons of graphs, me. The parting words overall, I tend to kind of look at things from a 30,000 foot drop. I like to do that because it keeps me sane, maybe. But the economy trends just like everything else. Different investment categories trend, real estate trends, gold. Everything you can think of. So it's the same thing. We're kind of going through this period of rate increases and inflation. Has the United States seen it before? Yes, but not recently, right? Between you and me, we probably haven't seen it in our most recent, 20-some years. So this is new territory, but it's just something that we're going through as a nation, and we're going to come out hopefully stronger on the other side, again, after all the rate hikes in order to undo all this inflation. We're going through the motions. Not too concerned about it, but again, you do want to review things, like you had said, making sure that expenses are in line, and just taking a long, hard look at your future goals and trending towards those goals, so they match up with what you're doing in today.
Well, Greg, I can't thank you enough for joining me today. This has been awesome information. For those of you out there watching, if you haven't already, you got to go out to Greg's website, reach out to him. At the very least, get on his newsletter. Again, I read some newsletters I get, not just so people know, but I mean, this is one I read every word of every time it comes out, even about Greg's family. I feel like I know his family inside and out. So definitely get onto it. Greg, can you just give one more shout out about how best to reach you?
Oh yeah, absolutely. So the website is Kojak Capital, Kojak Capital.com, and my phone number, you can feel free to call 773-572-6455, and my email address, Greg, Greg at kojakcapital.com.
Awesome. Well, thank you again, Greg. Take care, and we'll have to check back later this year and see what's really happened.
Yeah, I would love to do a revisit.
All right. Thank you.